Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. Hi, everyone. Welcome to the 58th episode of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we're titling this one, Houston, we have a correction. Because if you've been paying attention, you've been paying attention to the news, there's a market correction out there. It is scary because it's Halloween season as well. If you're looking on the YouTube channel, you probably wonder what in the world I'm wearing. I'll tell the listeners in a second here. Sonu, Halloween, you've got some twins. Are you going to let them eat the candy, or are you just going to eat it all? What's the plan?
It always starts off with them, collecting all the candy, and then they, we have notions of regulating that, but by day 20, I'll put it this way: by day 20, 3 weeks after Halloween, they're still eating the candy. Are like, okay, we need to put a stop to this. Kids, we're putting it away, and then we eat the rest.
Yeah, my kids are older, so I don't know if that means they're more devious, but I think it does, to be honest. Like, I'll see 2-3 weeks later, we thought all the candy was gone, and you see a couple of wrappers. I think they've got resourceful ways to do that. You dress it up this year by chance, though? Are you going to do anything?
Not dress up in particular, but I do have a friend behind me for those who are not watching the YouTube channel. He's usually outdoors, but I brought him indoors. So I joke that my kids are not very original. They just call him Skelly, but just for everyone listening, it's just a skeleton. And he does have bull horns on top of him. I put the bull horns on top of him. So.
And we were saying, we wonder if with the way the market's been acting, we need to maybe take one of the horns down or something. Yes. Only it's a one-horn bull market. But here, I'm going to take my earphones off here.
Oh, yeah.
And I'll show you. Here's me. Just if you're watching YouTube, you'll see this. Here we go.
Yes. And Ryan's got a shiny... I don't know if it's a space suit, but it kind of is.
Can you hear me, Sonu?
Yes,
I got my headphones off. I can't hear you. I'm going to assume you can hear me. On the YouTube channel, I'm wearing a futuristic...
All right, I'll take it off.
Well, do like a double thumbs up.
There we go. I took that off. Now I'm going to put my headphone back on. Okay, there we go. Are you back, Sonu? Can you hear me?
Oh, yeah.
Right, there we go.
Very Daft Punk-ish.
Could you hear me? Could you hear me when I was wearing it, when I was talking? Could you hear me okay?
Loud and clear, yeah.
Okay.
Yeah.
Yes, so that's my futuristic Daft Punk. For those of you who were in Nashville with us at Excel, that'll make a lot more sense. I wore that as we talked about the future with our more than 350 Carson partners. But that's why I've got a silver shirt on and the Daft Punk looking futuristic helmet. That's why I'll throw that on for the podcast. Well, Sonu, let's get into it. We're going to try to keep things around 30 minutes like normal. Again, we're titling this one, Houston, we have a correction. So we're going to start with that, talk about the stock market correction. To be very blunt, weakness in October we were not anticipating. We'll kind of talk about why that potentially happened as well, but still optimistic that we're pretty close to the low and we might have still a decent size into year rally. We still think it's possible. Then we'll take a look at the last week's GDP number and then an economic roundup. All in all, economy still looks really strong, which is a definite positive. Then we're going to finish things up with the F word, the Fed. By the time people listen to this, the Fed might have already been out, but we feel pretty comfortable saying the Fed's not going to do anything, but it's all about what they say and how they lay the groundwork for the future. So again, let's just dive in, Sonu. The S&P 500 as of Friday was down more than 10% from the July 31st highs. That is classified.
And that's a correction, right?
That's that by the definition. By the definition, that's a correction. We had a mild pullback. You're between 5 to 9.99%. Once you hit 10 on a closing basis, that is a correction. So again, that's the biggest. That's the biggest peak to trough we've seen all year. I think we had 8%, give or take, back in March. So we're going to, I just want to start with that. Let's start there. But before I even go there, some context. Give me a second. I wrote some notes down just for context on corrections, and then I'm going to pull you in, Sonu. Okay. All right. Let's see here. This is, by the way, This is from PIMCO. That look familiar? Our friends at PIMCO. Yeah. Last week, we were there 2 weeks ago, but last week's podcast with Dan Iveson, the group CIO over at PIMCO, an amazing podcast. You should listen to it, especially with what's going on in fixed income and the economy and inflation. Listen to it, but I wrote down in my new PIMCO little booklet here. Since 1980, Sonu, I just looked at peak to trough correction on the S&P. Your average year sees a 14.3% peak to trough correction. Remember, we just hit barely over 10 this year, right now. Believe me, by the time you listen to it, maybe it could be a little more. We'll see. But we are bouncing at the time we're recording this on October 30th, Monday. But let's see here. So about a 44 years since 1980, so half of them, 22, have seen at least a 10% peak to trough correction. So it's normal. You know, it doesn't happen every year, but it can happen. And they're obviously happened this year. Looking at those 22, though, I found 12 times the market finished higher on the year. I mean, we're up, 7, 8, 9% or so in the S&P 500, give or take, depending on kind of how today closes and total return. So we're still pretty comfortable. We're going to be higher on the year when all is said and done. That's definitely what we're expecting. Looking at those 12 times, so you had a correction of at least 10% and finished higher. The S&P on average was up 17% on average, right? So you can have, volatility pullbacks and still have, a solid bull year. We think that's where we are. But let's go this route, because a month ago, someone would have listened to us, and we're going to talk about November and some things soon. But the idea that October we expected to see more of a bounce in October, to be honest, and we haven't. Why is that? Why do you think the market was as weak as it was this October when there were some signs we were supposed to have a bounce?
Yeah, and even the fundamentals are looking good, right? We'll talk about the economy and earnings and all of that, but I think I put it down to. It's easy to put down, sort of Monday morning quarterback the market, right? I shouldn't say easy, but it's easy doing that, whether it's right or wrong. But we did see some geopolitical risk, right, with the tragic events in Israel. I think that's put a little bit of lid on, the market rally. I mean, I think the market was trying to rally. I mean, it seems like every Monday morning. How many Mondays have been positive in a row, Ryan? I mean,
well, we were down the previous Monday. I think we were up 15 or 16 in a row, then down. And now this Monday, the time you're not recording, it's another nice up day. So let's just say over the last 3 months, only one down Monday, and most of them were some really big gains.
Right. So, after the weekend, people come back, they want to buy. So you think, okay, things are, folks have had some time to digest the events and data and all of that. You come back, Monday looks positive. And then during the week, it's just been more bad news or seemingly bad news, and things have just headed south.
No, exactly. I mean, it's quite rare, honestly, to have August, September, and October all three down. You can have weak third quarters. We talked about that a lot. I'm aware, though, if I looked at my calendar, October is not in the third quarter, but nonetheless, you can have that. But at the end of the day, I think it's the realization that we have a terrible tragedy taking place in the Middle East, and the concerns that brings. At this time, we feel fairly confident, as terrible as this is, confident to say it's going to stay in that region. We don't expect the U.S. and other parts of the world to get involved. Obviously, if that were to take place, we would think the stock market probably going to go a good deal lower. We're obviously watching it closely every day, like everyone. We're praying it can have this peaceful resolution and as timely a resolution as humanly possible, but we just don't know. We don't know on that front. Definitely listened to a couple weeks ago, Matt Gommel, our partner down in North Carolina, who came on and joined and talked about things. But nonetheless, that happened. It is what it is. It happened, as terrible as it is, and that definitely, I think, hurt stock markets from that point of view. But let's kind of take a little more dive into this, Sonu. Where do I want to go with this? Go ahead.
I have a question about, you mentioned like 22 years since have
since 1980
corrections, right? Since 1980 have corrections, and what 12 of them you said were ended up being finished high, right?
Right.
And out of the remaining 10, I imagine most of them were during years where you had a big recession, like 2008, 2001, things like that, right?
Yeah, I mean, they were vicious bear markets. I might actually have it in front of me. Maybe we can see here. I might have it here. Yeah, I do have it in front of me. I mean, the bottom line is, the years with the biggest pullbacks are some of the worst years. I don't think there's anything that, isn't too hopefully too wildly obvious here. I mean, we can cherry pick. I mean, we can do that, right? I mean, 2001, there was a 29.7% peak to trough correction. 2002, 2002, a 34% peak to trough correction. 2008, oh boy, you want to take a guess? What do you think 2008's was, if you want to take a guess?
Oh, peak to trough, was it 50%?
Yeah, 48.0%.
Okay.
2009, obviously, in the beginning, 28%.
Wow.
So the truth, again, those are all very poor market years, right? We know that. When you have the bigger market corrections, bear markets, maybe a better word to use, you're going to have the worst returns on the full year. But again, when you consider the fact that we're still higher, we still have a positive economy, a lot of these things suggest, again, this hasn't been very fun for people if you've been fairly bullish and constructive on the market. But again, it potentially was a necessary evil when you consider it was the best first 6 months ever for the NASDAQ, best first 7 months for the S&P 500 since 1997. And then when you layer on, we were talking, so you write, you and I together, I guess, we put a weekly together for our Carson partners, go through clients. We did a Monday morning call. You mentioned 3 things that have happened over the past couple of years that when you think about it from this point of view, the fact that we're even, hanging in there like we are is fascinating. What were those 3 things that you mentioned this morning on our call?
Yeah, so I mean, you think about the economy, we've come a long way, right? I mean, we'll talk more the details of GDP, but I'll just say this. So GDP growth, the Congressional Budget Office makes projections every year for GDP growth. And right now, just before the pandemic, they'd made projections. This was in January 2020. They made projections for GDP growth after adjusting for inflation, right? So after this third quarter GDP data came out, 4.9%, turns out the economy is larger than the CBO projected back in January 2020. And wait a minute, that has happened while we had a worldwide, global, scary, I was going to say something, but I won't, scary pandemic, right? Millions of people died, businesses shut down, people got laid off, and, it was awful, right? Amongst everything else that happened during the pandemic, stay at home, all of it, right? Not being able to see family, weddings, even funerals, right? To be honest.
Yep.
And then we had a massive energy shock, right? We had the biggest energy shock since the early 80s that sent inflation to the highest level since the 80s, to more than 9% consumer price index inflation last June. And usually when you get an energy shock like that, we get pushed into a recession. Not this time, right? And then in response to that, the third thing was we had the most aggressive Fed tightening cycle in 40 years in response, like I said, to that inflation. Again, it's not like, yes, the economy didn't go into a recession, at least not yet, and we don't think anytime soon. It's not like it didn't have an impact. The Fed crushed the housing market in 2022. And even now, the existing home sales market is, close to being, dare I say, dead, like the skeleton behind me, because of higher rates, right? I mean, and housing downturns usually precede a recession. Again, not this time, right? So, we're in a different place. And it's probably a good time to get some perspective on how far we've come despite all of that.
No, you're right. I mean, again, 100-year pandemic and all the fallout that came from that. You mentioned, a massive energy spike, which historically big spikes in inflation tends to equal a recession. And then the Fed most aggressive rate hiking schedule we've ever seen. Looking forward, though, let's cross our fingers, cross our toes. We're going to have another major pandemic, 100-year pandemic on the horizon anytime soon. Let's hope. You've got inflation drastically coming back down. We can maybe talk about that when we talk about the economy next. And then the Fed, we think the Fed is done. We'll talk about that as well. So again, those are some big picture things that when you think about it, wow, maybe then you think about impact, and we can talk about earnings for a minute here. Earnings and stock market are kind of related. I mean, we have had 3 consecutive quarters of negative year-over-year earnings growth. The caveat being, every one of those we came in a little bit better than expected. I think that's a big reason why earlier this year and everybody and their mother was talking about a recession. The earnings came in, they were still negative year over year, but they're way better than a lot of those bears were thinking about that were staring at the yield curve the whole time. And now we look forward, we're going to have likely positive earnings growth here in the third quarter. It all wraps up. Fourth quarter should be solid, but out into next year, we could be having double-digit earnings growth. And who knows, if the economy is even stronger, you've got some reasons to think earnings could hit all-time highs next year. Take a wild guess, everybody, what tends to happen. You hit earnings at all-time highs. Stock market tends to follow as well, right? And so it potentially could hit all-time highs as well sometime. Maybe not this year, to be honest, maybe we're running out of time, but maybe in the first half of next year, all-time highs aren't all that far away. You want to talk about earnings season so far? What you think about it? What grade you give it, maybe? Yeah.
I think at least a B plus. I mean, you want to save the A minus and A plus for really superlative years, but better than average, right? I'll put it there. Better. That's why I picked B plus, right?
There you go.
More than half of the companies in the S&P 500 reported. It make up about 60% of the market capitalization of the S&P 500, right? And look, companies always play this game. They kind of they give a lower estimate for, forward guidance, as they call it. So when they actually report, oh, wow, it's a surprise, right? So surprises by itself is not a big deal. I mean, everyone's, more often than not, the 10-year average of companies surprising their EPS profit estimates, it's about 74%. So far, that's running, close to 78%. So we're doing a little better than average. And if you think about, okay, how much do they surprise by their profit growth or earnings per share growth? They're surprising by about 7.7%, right? Again, a surprise is not uncommon. The 10-year average is about 6.5%, right? We're doing a little better than that, which is great. And with respect to overall earnings growth, we've had a few quarters of, and this is looking back, right? Even Q3, like current earnings season, it's for the third quarter. That's looking backwards, but still, it tells us something, right? Companies are talking about, they're no longer talking about, at least not too much. They're not talking about price pressures, right? That's a big difference from last year. And then turns out if you actually remove the energy companies out of the index, I'm not a big fan of stripping out different companies out of the index.
Sure.
It is what it is. But last year, energy companies, saw profits grow by 130%. There was bound to be a pullback. This year, energy company profits have gone down about 40%, right? So that's been a big drag on the overall index's, earnings estimates. But you take that out, earnings are growing about 8%, just above 8% in the third quarter. That's pretty good, I would think.
No, it's interesting concepts that you talked about. I was looking for it. I don't seem to have it, but revenue has been higher. I forget how many times, 8 or 9 quarters in a row. Do you know that by chance, Sonu? Revenue has not been negative, whereas earnings have been. Right. Revenues continue to be higher, and just McDonald's, right? Not a recommendation, although I do like a McDonald's. My kid, by the way, my kids don't like McDonald's at all. I grew up eating it, maybe.
Really?
Anyway, I can do the McDonald's thing. They came out today on Monday, and their stock's up a couple percent. Their earnings came in better than expected. They said, hey, you know what? We increased prices, and it didn't seem to impact anything. People still bought our Happy Meals. They still bought our French fries. They still bought our Coke. They still went to McDonald's. And I get the arguments like, well, you know what? When Walmart does well, that's a signal for the economy. And listen, I've been hearing this for 22 years doing this stuff. I don't know. I still go to McDonald's. It's still crowded. I'm not sure that's a sign everybody's going to buy a quarter pounder because it's on sale, maybe. Or the McRib. Maybe because the McRib is back, even though it was supposed to be gone forever. Maybe it's because, anyway, whatever you want to say, McDonald's is one big company that's flat out said, hey, we did increase prices. It's there. You can't argue. Prices are higher now than they were a year ago, but people are still buying there. All right, so anything else on earnings? I mean, I know by the time people listen to this, Apple's coming out, some big names. I mean, they're going to matter, right? I mean, what Apple says, what NVIDIA says in a couple weeks, I mean, that's going to really let's not forget what NVIDIA did last May, right? Remember May, they came out with the biggest beat maybe in the history of any earnings beat of all time. I forget the exact numbers. We're talking like billions and billions and billions of dollars, tens of billions of dollars. Analysts are off. What do you think about kind of how it's going to finish up? Maybe that's my question.
I think, look, it comes down to, you just mentioned sales are positive. Sales have been positive actually throughout, the last how many of a quarters, right? A long time, basically.
Yes.
And it gets to the fact that we haven't had a recession. If the economy is growing, look, profits come from the economy, sales come from the economy. If the economy is growing, sales are going to be positive. People are buying stuff, right? But here's one last thing. And this gets to the strength of the U.S. economy versus the weakness outside the world. So companies with more than 50% revenue in the U.S., they're seeing profit or earnings per share growth of close to 7%, whereas companies with less than 50% revenue in the U.S., so we're talking like companies, some energy companies, healthcare companies, things like that, they're seeing revenue growth negative 5%. Or sorry, EPS growth, earnings per share, profit growth, negative 5%. Just gets to the difference between how well the U.S. is doing versus, the rest of the world.
One other thing, I'm going by memory here on our call this morning with our partners, but you showed how the U.S., since I think it's pre-pandemic, our economy's actually grown. Like nobody else in the world has seen economic growth since the pandemic. Did I say that correctly, or you want to talk about that for a minute? I thought it was fascinating.
No,
but not fascinating enough to remember, apparently. So let's just specify that.
I think you remember the gist of it, because I didn't even put numbers there. It just showed a chart. I mean,
Right.
So look, as I said, the CBO expected the economy to be this size only by the end of 2023. We've gotten there a quarter early, and we've gotten there despite three big shocks: COVID, the energy shock, and the Fed, right? And COVID was, after COVID started, obviously everyone took down their estimates of how much GDP the economy will grow for the next several years, like the IMF and places like that.
Yeah.
And they expected everyone to have scarring. Obviously, you would, right? COVID was a big hit to the economy. They thought all these economies are going to suffer. They're going to be, doing much worse off than we thought before the pandemic. Well, it turns out that's true everywhere except the US. The US is actually done, as I said, it's doing better than they expected before the pandemic. You take everybody else, China, other emerging market economies, developed market, Europe, Japan, all of it, Canada, they're all doing worse than, the projection was before the pandemic. So, the US is shining.
Amazing. So I'm going to wrap this up here. I just, like I like to do, play with some numbers here. Now, again, don't blindly invest in these things. I mean, there were a lot of reasons to think October we'd see strength. We didn't. So I want to be clear there. At the same time, Sonu, I took a look when you're down 3 months in a row, or at least 3 months in a row going into November. Let's see here, but up year to date. So again, a decent year, still up year to date, right? But you're down to 3 months before going into November. Only happened twice. This could be the third year in all likelihood. 1952 and 2016. November in 1952 was up 4.6%. November in 2016 up 3.5%. The final 2 months of the rest of the year up close to 9% in 52 and up over 5.3% in 2016. Just some things to think about. Your average final 2 months is, say, only 3.2%, so much stronger. Now, here's some other good news. The best month of the year on average since 1950 is November, up 1.7%. It's the past 20 years, November is the third best month, and the past 10 years, it's the second best month. So we're very oversold coming into a really strong month historically. Just be aware of that. A couple more for you. When you're down in October, again, I think it's safe to say we're probably going to be down in October. We have a massive rally on Halloween, and we missed that. We'll not miss it. We'll be there, but we're recording a day early. Down, but up year to date. So again, believe me, there are some years October's down a lot, but it was a bear market. I'm kind of throwing that out. When you're up year to date and you're down in October, the last 7 times, going back to the late 80s, November was actually higher. And then back to 1950, when that's the case, November is up 2.4% on average, better than the average year. Again, when you're down in October, but up on the year. So just some context, I think, to put around why we still think there likely can be a end of year rally and end of the day. I think it's going to be the Fed saying that, they're likely done, and the economy strong with strong earnings are kind of what's going to spark. It's also maybe the fact that everybody's getting bearish again. We've had a correction. It's in the headlines. It hasn't been fun. There's a lot of negative sentiment starting to come out there that we're seeing. Just one easy way to put it, the AAII sentiment poll, we had the highest bears since May, right? And there's some other ways to look at NAAIM, National Association of Active Investment Managers, I believe. Okay. They just had a massive drop on their weekly exposure index. Now, these are people with real money, what they're doing. Not surprising because, again, market's been rough, but all of a sudden we're entering that really seasonally bullish end of the year, fourth quarter, end of October tends to be pretty strong. All right, Sonu. So there we go. A good discussion there. Look at the clock. You and I can talk about this stuff all day. We need to probably move forward. Well, we've got the Fed and we have the economy. I mean, which one do you want to, we said we'd end with the Fed. I'm okay with mixing it up. What do you want to talk about the Fed quickly and then go to the economy? What do you want to do?
Actually, let's do the economy, and then that'll give us some context for what the Fed may or may not do, right? So
okay. So I'll set you up here. We had a GDP number came in way better than expected. Take it away.
Wow, way better is an understatement for what just happened, right? So third quarter GDP growth, I think most people are expecting. By the way, again, to set the context up, in July, early July, most forecasters, economic forecasts, economists, half of them were predicting negative growth in Q3, Ryan. Half of them. Throughout the quarter, we got good economic data. You and I have been talking about that in this very podcast, week after week. And they moved up their expectations, right? The expectations by, through last week was close to about 3.5%, 4%, right? Maybe slightly higher than that for folks who follow the Atlanta Fed. GDP nowcast. But look, Q3 GDP growth came in at 4.9%. Let me repeat, 4.9%. That is after adjusting for inflation, right? Which is incredible. If you didn't adjust for inflation, Ryan, the economy actually grew 8.5%. This is annualized numbers. 8.5% in the third quarter, which is phenomenal. Now, of course, that means, once you adjust for inflation ran about 3.5%. Right. There's good news in that. A year ago, inflation was about 6.5%. That's come down to about 3.5%. And we are seeing strong growth even after adjusting for that, right? So where did this growth come from? So the big boost was actually businesses restocking inventories, right? Businesses, had taken down inventories over the last year. But look, they're looking at future demand and they're thinking, you know what, the economy is not falling off a cliff. We need to restock, right? So that process basically added about 1.3 percentage points to the headline GDP number. And exports minus imports, is the only drag that dragged by about 0.1%. So not too much. Usually, these are the two most volatile parts of GDP, inventories and exports. You take that out, right? Then you get what we call real demand. Why real? Because you're adjusting for inflation. That was running about 3.5% in the third quarter. So that gives you a sense of the underlying speed of the economy. You take out I've heard a lot of things about, it's just government spending. Not really, right? You take out government, real private sector demand was running about 3.3%. That's really strong. And so you had this acceleration of demand and spending in the third quarter, right? Mm-hmm. And
that's I was going to ask you to do all that again. I'm joking. If you watch the YouTube channel, I just had some fun. I took off my headphones and put the spaceman helmet back on, so I couldn't hear anything. But I think I know the gist of what you were saying for most of that. I mean, that's something I heard a lot last week. They said, I don't even know who they is, but people on TV and in the media, they said, well, we saw a big jump in government spending. And you really, historically, we've seen jumps in government spending when? In recessions, because those are the levers the government can pull to get things going. So the talk, at least, that we heard was, does the government know something we don't know? I mean, you just listed all these positive things, but if the government's out there spending aggressively, that's one of the things they can do to help get you out of a recession. Talk about that, but along the lines of national defense spending, perhaps.
Yeah, I'll put it this way, right? To your point, usually government spending rises when everything else is falling off. Mm-hmm. Everything else is not falling off. Consumption is really strong, both services and goods, right? The other thing I heard was it was just the Barbie movie in Oppenheimer or Barbenheimer, and it was Taylor Swift concerts, right? No. Like even restaurant and bar spending was up about 6% in third quarter. It added about 0.27 percentage points to the headline GDP. And people are still spending on goods, like 3 years down the pandemic. Like recreational goods vehicles is up about 16%, quarter over quarter. This is annualized pace. Furnishings are strong. Apparel purchases are strong. We know all that from retail sales. But it's nice to see everything together. GDP growth was strong because, at the end of the day, it was mostly consumption that added the biggest piece to headline GDP. But government was strong, right? And across the board, you have the federal government and you have state and local spending as well. So federal government, there's non-defense and defense. Defense spending was actually up, Ryan, 8% in the third quarter. That's the fastest since the fourth quarter of 2020, right? And right now, if you look at defense spending as a share of GDP, it's running just under 4%. That's the lowest ever. And if you think about what may come in the future, I think defense spending rises from here.
Let me jump in there for a second because Neil Dutta pointed that out to you and I on this very podcast from Renmac a couple months ago, and I didn't quite know that. Now it's something you and I know are both watching closely. That again, defense spending as a percent of GDP was historically low, and his take then was, look around the world, we might have to see that increase. And now everything that's happened in October in the Middle East and different areas, believe me, that's probably. Well, unfortunately, probably true that there's going to be more spending on the defense side of things. Now, I mentioned Neil. Neil does amazing work. We're such fans. He pointed one thing out recently, or three things. I just want to touch on these quickly here. There were positives that honestly a lot of people aren't talking about, right? GDP was strong. We get it. Earnings pretty good. We get it. Here are three things Neil talked about that aren't out there. He saw raw steel production up 2% year over year. That's with many plants and shutdowns and lockdowns and strikes going on. So that's pretty impressive, I think. Red Book does a same store sales up 5% year over year. People say, well, it's because of inflation. I get it. Maybe to buy the dress you wanted to buy a year ago, it costs more. We're still seeing really strong consumption, like you talked about, according to the Red Book. And that is the highest in September, that 5% year over year. Final one that Neil noted, railroad traffic up 1.5% year over year. And it's been positive year over year the last 6 weeks. So again, these are things that aren't out there, so to speak, but are suggesting, I think, continually the economy is on better footing than darn near everybody thinks. You want to build on that?
Yeah, look, one thing you mentioned is like the Red Book sales was interesting because we just talked about the consumer. It was up 5%. Yeah. Yes, it could be inflation. But at the end of the day, and I would be the first to point out you have to adjust for inflation. Look at real spending, right? Look at volumes. Is that increasing? Yes, that's important, right? But at the end of the day, you and I live in a nominal world, so to speak. We spend nominal money, right? I mean, we earn in nominal dollars. You're spending nominal dollars, right? If we weren't, confident about our jobs, things like that, we probably wouldn't be out there spending. And I imagine that goes, that's true across the board for everybody, all American households.
Yeah, over the weekend I was reading some survey data. I get it, survey data. Consumer confidences are still relatively low. CEO confidence relatively low. CFO confidence come back a little bit. But one of the things that's one of the highest in like decades, at least according to this one survey, and I forget who it even was, to be honest, but it's comfortable at your current job. Like people are happy. People like their current jobs. And again, I think it's a factor of things. I'm having a blast working with you every day, but I like the fact that I'm on airplanes a lot. I don't have to go in an office a lot. Give me internet. Give me a phone. I can do my job. A lot of people are like this. It feels, the pandemic was horrible, but the fact that we've got this flexibility to do our jobs a different way than we could before, and I'm aware a lot of people don't have this flexibility, we'll be very clear. But for those of us that do, it is a really nice way to live, I guess is what I'm trying to say here.
Yes. Yeah, between both of us, right? I won't say much more of it. I don't want this to go away. But, there is that thing of sentiment is actually pretty poor, right? And what's interesting is everyone's sentiment is poor sort of, in the abstract. I'll get concrete about this. So here's this is a survey taken by the New York Federal Reserve. They survey consumer expectations about the economy and their own economic prospects, right? So it turns out consumers expect the unemployment rate to increase in the future, right? They're negative on that. So basically, no surprise. They're all negative on the economy. But when they are asked about their own job situation, they actually feel pretty good about that. In fact, the probability of a respondent to the survey saying they're going to lose their job over the next, 12 months, that's actually lower than it's ever been. It was low. It's much lower than it's been before the pandemic. So what's interesting is everyone feels like, oh, you know what? Our job feels, fingers crossed, knock on wood, whatever you're doing. Yeah. My job feels pretty good, but I think the unemployment rate is going to go up over the next year. Right? Square that.
Interesting. Yeah. Interesting. Yeah, the good stuff there. And as I'm thinking about this, like next week, I'll be in Chicago for a day and a half. Hopefully get to see you and go from there. So, all right. So you did mention Barbenheimer, and I don't know if I've talked about this on this podcast. We had a couple pre-recorded podcasts and things, but I want to bring it up now. If I did, apologies, but we're just going to talk about it one more time. I did see Expendables 4. Remember I said I wanted to go see Expendables 4. I have to admit, and this kills me. It kills me to do this. It was terrible. It was terrible. The rumors were true. It just wasn't any good. I don't know why. I love movies with explosions and over the top, and just I like that stuff. I grew up in the '80s. I grew up watching that stuff. It just, I don't know. Expendables, in my opinion, peaked with 2. Expendables 2 was amazing. Jean-Claude Van Damme is the bad guy, and 3 was horrible, but 4 wasn't much better. So kind of sad in my opinion. I see why it didn't make much money.
Are you saying Oppenheimer was better than Expendables 4?
Oh, my goodness. I don't know what I'm saying, because I was about the only person that ever walked the face of the earth that didn't really like Oppenheimer. Oppenheimer was better. I can't believe I'm saying this. I didn't like Oppenheimer either, but anyway, yeah. It was. I didn't see Barbie either, though. So maybe, who knows? Maybe Barbie's better than all of them. I don't know. All right, so let's wrap things up here. Yeah, exactly. Let's wrap things up here in 5 minutes or so. The Federal Reserve is set to have one of their every 6 weeks they have a meeting, and they talk about interest rates, talk about the economy. In all likelihood, we've seen different numbers depending on your source, but it's like between a 1% to 3% chance of rate hike. We're just going to go with they're not doing a rate hike. By the time you listen to this, it's probably already happened. We are aware. So let's just assume there's no rate hike. What do you think the Fed's going to say that maybe could spark a rally, or maybe, move yields higher? And we've seen higher yields. Stock market hasn't always liked that. What do you think could be the thing that happens after this?
This is not going to be very original because they basically are going to stick to the language they've been using for the last couple of months. But even Powell, like recently, was at the Economic Club of New York. I mean, there was some market volatility after he spoke because I think, there was some misspeak, whatever it is. Forget that, right? But I think what they're going to say is, yes, they're not going to raise rates. But that's because they think, look, inflation's going in the right direction. It's still elevated. That's what they've been saying. Look, core inflation, as measured by their preferred index, the Personal Consumption Expenditures Index, that's running at 2.5% annualized pace over the last 3 months, right? I mean, there's little bumps along the way. Airfares are up in September. Accommodation, hotel prices were up. But, we're seeing gas prices come down and sorry, that was September. We're seeing gas prices come down. So these things will reverse. And these things, inflation going down is never going to be a straight line. There's going to have some bumps along the way. But the general trend is lower. So they're not going to raise rates, or they probably haven't raised rates by the time you listen to this podcast on Wednesday or soon after. The Fed meeting's on Wednesday. But I think they're going to say that, look, the situation's changed from last year. Last year, the risk was of them not doing enough. Right now, it's more balanced. There's a risk of not doing enough, right? Inflation could go up again. But there's also a risk of doing too much, right? They've been talking about the risk being more balanced. And because of that, they feel like, okay, we don't need to raise rates anymore, but we're just going to stay here. We're going to pause, right? Now, the other side of that is, are they going to cut? I think that it'll be the magic. Look, the Fed can't really say they're going to cut rates anytime soon. Not when inflation's running about 3.7%, right? It's much higher than the target of 2%. The thing is, the moment they say they're even thinking of cuts, the market's going to take off, right? So they're not going to say that, especially because, look, the economy is doing strong. So there is a risk that a strong economy will lead to higher wages, and higher wages could potentially lead to higher inflation. Now, I don't think that's going to happen because, at some point we'll talk about this, because I think productivity is going to be running strong. But they're going to think, the economy is strong, so there's no reason for us to even talk about thinking about cutting rates at this point. I think that's going to be the big message.
No, well said there. I want to dive into something. I know we're kind of near the end, but what we've seen lately, and we are creatures of habit, right? The pandemic, the Fed cut rates. Things didn't do too well. Financial crisis, the Fed cut rates. Things didn't do too well. Tech bubble, the Fed cut rates. Things didn't go very well. You just said potentially the Fed maybe cuts rates sometime next year, but you think it's going to be bullish? Can you go into that a little bit?
Yeah, and that gets to the idea of a soft landing. When do we know it's a soft landing, right? I mean, right now, yes. I mean, they haven't let's say they haven't been able to push the economy into a recession. I mean, goodness, economic growth last year was running about 1.5%, 2%. It's accelerated to almost 3% now if you look year over year, right? And inflation slowed, right? So they're like, you know what? We'll take it. We'll take by the way, Ryan, I think Ryan's dog just barked, which is, maybe he wants to say something.
This is productivity at its most. I'm looking at my phone as someone rang the doorbell. So I'm looking right here. If you see on the YouTube channel, I'm looking who rang the doorbell. Literally no one's there. It's probably something got delivered, and now my dog is barking, my other doorbell. So, I was going to go on mute here and say, just don't ring the doorbell. Oh, there's a car leaving. Someone's leaving. Oh, it is Amazon. Yep. Okay. So my dog is barking. My wife's not here. Sorry. You're going to hear my dog upstairs barking right now. Where were we? I'm looking at I'm like, we almost made it through. We almost made it through without my stupid dog barking upstairs. And anyway, we did not.
Okay. Yeah. Maybe he wants to chime in on the Fed. What were you talking about?
He hates the Fed, Sonu. I mean, he hates the Fed. I'm teasing. He doesn't hate anything. He loves everybody. If Jerome Powell would have come in and scratch him, he'd be the biggest Fed lover there was. Let's put it that way.
So what were you talking about? I think the Fed.
Sure.
We can go with the Fed. But look, they're not going to be raising rates anytime soon. We think they're done. But at the same time, they're not going to be talking about cutting rates. But we do think next year, this is where it gets interesting, right? They've projected core inflation to end 2023 at 3.7%. I think it could be short of that. So when we get the December meeting, the December dot plots, their expectations for the future, then we could see them say, you know what, inflation's come down below our projections. Maybe we project out a couple of more rate cuts than we did back in September. That could be a catalyst for a rally. Will they cut anytime soon? No, I don't think they'll cut anytime soon. But I think things will start to get interesting in May and June of next year, right? I think inflation will go down, and the Fed may cut, not because the economy is weak, because look at spending. Everything's pretty strong right now. But because inflation's coming down, that's really what the Fed's, that's what they care about, right?
Yeah,
Ryan's gone on mute.
I'm just laughing. It's this dog up there going nuts. He hates the Amazon guy. I mean, literally, so sometimes we have him outside, okay, and we get this alert on Amazon, get your dog, because he's petrified, because he thinks the dog's going to eat him. Even though Walter, honestly, is big, he's 140-pound Great Pyrenees, he's the sweetest boy ever, he still likes to bark at everyone. He's out there barking as we speak, stupid dog.
The Amazon guy must have run off.
Well, Walter was inside. That's kind of why it's raining. It's raining here right now, so he's inside. So anyway, all right, well, Sonu, I think we probably better wrap it up. I'm gonna go yell at my dog for barking into my podcast here. This was a really great discussion, I think, as we talked about Houston. We have a correction, taking a look at the stock market, where things are right now in the midst of a pretty rough couple of months. Still optimistic, though. We're still going to see an end-of-year rally. We're still bullish. And one of the main reasons, the economy is so darn strong, as you talked about from the macro point of view, and we finished up with the Fed again, that likely is, we think, done. The Fed is done hiking. They're not going to come out and blindly say that. And you just talked about maybe there's a chance they could actually cut next year, and it could sort of be like the mid-90s scenario where the economy held on its own. Things improved. They slowed, sure, but things did okay. Then the Fed started to cut, and that actually was a really nice spark. So we could see some similarities like that. So yeah, that's it, Sonu. Any final comments before I bring us home?
No, happy Halloween.
Yeah, happy Halloween, what's your last one, maybe? What's your favorite candy?
Oh.
I'll go first. I like Nestle Crunch. I like Nestle Crunch bars. You don't see them as often anymore. I mean, that's one, like when I was a kid going to the movies, I didn't like popcorn, maybe because I didn't like sharing with people. I've always been a germaphobe. I didn't like sharing popcorn with people, but I always liked Nestle Crunch. I've always enjoyed that one. I like the Snickers and Kit Kat, anything chocolatey, but if I'm at a movie theater or eating kids' candy, I always like, give me the Nestle Crunch. I like that one. Did I give you enough time to come up with something?
Yes, actually, on the Crunch theme, the Kit Kat. I like the Kit Kat.
Yeah.
You know what I really like? I like freezing it and eating it. Or just throwing it in the fridge. That's really good. Yes.
Oh, I didn't know that.
So okay, idiosyncrasy there.
See, the problem, every time I want to freeze something, like say a beer or something, I'll not freeze it, get it colder. You know what I always do? I always forget I did it. I put it in there, and I always forget. Oh, no, that beer's in there. It might be crack or something. But anyway, it's what it is. All right, everybody. Well, thank you so much for joining us. We've hit some huge numbers. The one we did with Cliff, you mentioned a little bit ago, like fall off a cliff. I think you said that reminded me. Yeah, we did this with Cliff Asness over at AQR. Huge numbers on that one. So thank you to everyone who keeps listening to this podcast. We'll keep doing it as long as you keep listening. Hopefully you enjoyed this one. Sonu, this was fun. And sure enough, we went way long. You should have known. Chelsea, our producer, is not with us. We don't have someone to tell us to stop talking. We just keep going. Even my dog was chiming in on this podcast.
That's
everybody
why
had a voice.
Chiming in.
Everybody wanted to talk on today's podcast, Facts versus Feelings. With all that, everybody, we'll see you next week. Take care. Thanks. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.